Want to make smarter investments? Stop guessing. Start seeing through the numbers. Today's tool, the equity multiplier. It's your X-ray goggles for a company's finances. Here's the formula: total assets divided by total shareholders' equity. That's it. Imagine a pizza. The whole pie is assets. Your paid slice is equity, and the rest is debt. The equity multiplier shows how much of the company's assets are funded by debt versus equity. If the multiplier is 1, there's no debt, safe, but maybe slow. A multiplier of 2, half the assets are funded by debt. More risk, more potential reward. Leverage can build fortunes or destroy them if you're careless. High multiplier, the company's using debt to grow fast, but too much and one bad quarter could spell disaster. It's not about borrowing the most, it's about borrowing smart. Your job: spot the difference between smart leverage and reckless risk. The equity multiplier is your first clue. Ready to see the market with new eyes? Grab your notepad, let's get to work. This is where real investors separate from the crowd. Booyah! Think of companies like amusement park rides. Low equity multiplier? That's the kiddie carousel. Safe, steady, no surprises. High multiplier? That's the roller coaster. Fast, thrilling, but risky. Conservative companies use mostly their own money. Slow and steady wins the race. High multiplier companies use debt as rocket fuel. Big gains when times are good, big trouble when things go south. Debt amplifies both wins and losses. Your job: decide if you want the safe ride or the thrill ride. High multipliers can mean growth or danger if the economy turns. Always check if the company can handle its debt, not just how high it climbs. Don't just chase excitement, look for stability under the surface. The equity multiplier tells you if you're on a well-built ride or a risky one. Analyze before you invest. Check the bolts, not just the height. Let's compare two giants, Apple and Verizon. Apple's 2021 equity multiplier, about 5.6. That means for every dollar of equity, Apple controls over $5 in assets. Apple uses debt strategically, funding innovation, buybacks, and growth. Why? Because their cash flow is massive and reliable. Lenders trust Apple, so borrowing is cheap and smart for them. Now, Verizon equity multiplier around 4.4. Still high, but lower than Apple. Why? Verizon's business, telecom, requires huge ongoing investments in infrastructure. For Verizon, high debt is normal and manageable because their revenue is steady. People always pay their phone bills. Apple's high multiplier signals aggressive strategy. Verizon's reflects industry needs. The same number can mean different things depending on the business. Don't just compare ratios. Understand the story behind them. High leverage isn't always risky. Sometimes it's just how the industry works. Context is everything. Use the equity multiplier to dig deeper, not just to judge. Numbers tell a story. Make sure you know what it is. Invest with insight, not just data. Is a high multiplier good or bad? It depends, like spice in food. The right amount of debt can boost growth, too much can burn you. Always consider the company's industry and stage. Tech startups might need more leverage to grow. Utilities can handle debt thanks to steady cash flow. But for cyclical businesses, high debt is dangerous. Compare companies within the same sector for a fair view. Your job: judge if management is using leverage wisely for their situation. A high multiplier in a boom might be smart. In a downturn, it's risky. Don't just accept the number. Ask why it's high or low. The equity multiplier is your clue to management strategy and risk. Use it to spot both opportunity and danger. You've got the formula, the examples, and the risks. The equity multiplier is your financial superpower. Use it. When you research a company, check its multiplier and compare it to competitors. Ask, is it rising or falling? What does that say about management's choices? Remember, this ratio is key to understanding leverage and risk. Don't be fooled by hype. Let the numbers guide you. Use the equity multiplier to find companies with smart, balanced growth. The market rewards those who do their homework. Stay sharp, stay disciplined, and invest with confidence. Now get out there and make your move. Booyah!